Before we dive in, I need you to do something for me right now. Pause this video, pull up any major financial news outlet, and take a quick look at their coverage of Bitcoin. Go ahead, I'll wait. You're back? Good. Now tell me, what was the general tone? Was it overwhelmingly positive, filled with predictions of new all-time highs and revolutionary potential? If it was, then what I'm about to show you will seem like it's from a parallel universe. Because the cold, hard, unemotional data from the actual traders and institutions who are putting billions of dollars on the line tells a story that is not just cautious, but one of deep-seated fear and a profound lack of confidence in any significant near-term recovery. This isn't about FUD, fear, uncertainty, and doubt, spread by media personalities. This is about decoding the multi-billion-dollar whispers of the options market. A complex financial arena where the most sophisticated players place their most strategic bets. And right now, those bets are screaming one thing and one thing only: protect your downside at all costs. Because the road ahead is treacherous. The key insight, the one that should send a chill down the spine of every crypto enthusiast, comes from a meticulous analysis of the data by Glassnode, focusing specifically on the behavior surrounding long-term call options. Now, for those who might not be options experts, a call option is essentially a bet that the price of an asset will rise above a certain level, called the strike price, by a specific expiration date. It's a leveraged tool for expressing bullish conviction. When you buy a call, you're not just hoping for a price increase. You're financially committing to the idea that a massive, explosive move to the upside is not just possible, but probable. In a healthy, confident market, especially after a significant price correction, you would expect to see smart money gradually accumulating long-dated call options, bets that look months or even a year into the future. This is how institutions signal their belief in a long-term thesis. They plant their flags in the distant future, buying options with high strike prices like $120,000, patiently waiting for their thesis to play out. This activity creates demand, which in turn pushes up the premium, or the price, of those long-term call options. It's a fundamental market signal of building long-term pressure. But according to the Glassnode data, that signal is not just absent. It's been inverted. The premium trends for these $120,000 call options are not increasing. There is no stealthy, gradual accumulation happening behind the scenes. Instead, the data reveals a far more cynical and telling behavior. Traders and institutions are using every single brief, fleeting price rebound, every tiny hopeful green candle on the chart, not as an opportunity to buy into their long-term bullish dream, but as a chance to sell those very same $120,000 call options to anyone still naive enough to be buying them. Let that sink in for a moment. The smartest players in the market are so skeptical of Bitcoin reaching even half of its previous all-time high euphoria in the foreseeable future that they are willingly acting as the lottery ticket sellers for the $120,000 dream. They are collecting pennies in premium today because they are virtually certain that those options will expire completely worthless in the long run. This is the ultimate vote of no confidence. It's not merely a passive absence of bullishness. It's an active revenue-generating bet against a major bull run. This behavior transforms the options market from a tool for speculation into a crystal ball for institutional sentiment, and the picture it reveals is stark. It tells us that the prevailing wisdom among whales and trading desks is that any recovery will be slow, painful, and capped. It tells us that they believe the macroeconomic headwinds, soaring interest rates, quantitative tightening, and a potential global recession are far more powerful forces than any inherent bullish narrative Bitcoin currently possesses. They aren't looking for a moonshot. They are looking to generate yield and hedge their core holdings in a stagnant or declining market. This creates a self-reinforcing cycle of pessimism. When large entities sell these calls, they increase the supply, which further suppresses the premium and confirms the lack of demand. This data then filters out to other traders, reinforcing the fear and discouraging any would-be bulls from making significant long-term commitments. It's a feedback loop of despair. all neatly quantified in the options chain. So, the next time you see a YouTube short or a tweet screaming about a potential 10x move, I want you to remember this data. Remember that while the public narrative might be one of hope and hype, the billion-dollar battlefield of the options market is telling a much darker and arguably much more honest story. Now, I want you to hit that like button if you believe the mainstream media is completely out of touch with what's really happening under the hood of the crypto markets. Let's see how many of us are actually paying attention to the real signals. So, we've established the grim reality of the $120,000 call options. But to truly understand the depth of the fear gripping the market, we need to pull the camera back and look at the entire options landscape, because the story gets even more revealing when we examine what traders are buying instead of those distant moonshot calls. The data shows a massive and persistent skew towards put options, which are bets that the price will fall below a certain level. This isn't just a simple hedge. This is a full-blown insurance policy taken out against a catastrophic collapse. The sheer volume and open interest in puts with strike prices significantly below the current market value, think $20,000, $15,000, or even lower, paint a picture of a market bracing for impact. Traders are willingly spending significant capital, which could otherwise be used for bullish positions on premiums for downside protection. This activity tells us that the dominant fear isn't merely missing out on a rally, it's the existential fear of a total washout, a cascade of liquidations that could send Bitcoin back to price levels we haven't seen since the depths of the previous crypto winter. This protective posture fundamentally alters the market's structure. It creates a heavy gamma wall to the downside, where market makers who have sold these put options are forced to dynamically hedge their own risk by selling spot Bitcoin if the price starts to decline, potentially accelerating any downward move. It's a built-in amplifier for panic. But the pessimism doesn't stop at just buying puts. Another critical piece of data is the behavior surrounding shorter-dated options. While the long-term $120,000 calls are being sold, there is some activity in calls with much lower strike prices and much nearer expiration dates. This is the realm of the gamma squeeze hopefuls and the short-term swing traders. They aren't betting on a new paradigm or a long-term bull market. They are simply gambling on a brief, violent short squeeze or a temporary relief rally that they can quickly capitalize on and exit. This is the trading equivalent of scavenging for scraps on a battlefield rather than fighting for the kingdom. It's a tactic born from a lack of any sustained, higher time frame conviction. When you combine this, the aggressive buying of long-dated downside protection with the timid short-term nature of any remaining bullish speculation, you get a complete picture of a market that has entirely lost its religion. The faith in Bitcoin's inevitable long-term appreciation, the number-go-up technology thesis that drove previous cycles, has been supplanted by a purely tactical, almost survivalist mindset. The market is no longer looking for reasons to buy. It's constantly scanning the horizon for the next piece of bad news that will trigger the next leg down. This is why positive developments, like a seemingly strong institutional adoption story or a favorable regulatory comment, often result in nothing more than a dead cat bounce that is quickly sold into. The underlying options-driven sentiment is so heavy, so skewed towards fear, that it acts as a ceiling on optimism. Every rally is viewed not as the start of a new trend, but as a selling opportunity for calls and a chance to buy more cheap puts. This creates a powerful gravitational pull that grinds the price action into a frustratingly tight and depressing range, slowly bleeding out hope from the retail crowd. The final, and perhaps most sobering conclusion from this data is what it implies about the concept of a bottom. A true market bottom, from a behavioral perspective, is typically formed when fear is at its absolute peak, but also when the smart money starts to see incredible value and begins making those contrarian long-term bets. We are seeing the fear, without a doubt. but we are utterly failing to see that contrarian conviction in the options flow. The absence of that steady, patient accumulation of long-dated calls is the single most important signal that, according to the most sophisticated capital allocators, the dust has not yet settled. The storm is not over. They are still in the bunker, and they are telling us, through their every trade, that it's not yet safe to come out and plant a flag for the future. The path of least resistance as defined by billions of dollars in options. Positioning remains firmly to the downside until this structural dynamic shifts. So I have a question for you, and I want you to answer it honestly in the comments below. Based on this terrifying data, do you think we are in the final stages of this bear market, or are we just in the eye of the hurricane, with the worst yet to come? Your perspective could help all of us navigate what comes next.